welcome to another Life After Hours, where we shine a light into the dark recesses of personal finance. And tonight we're talking about insurance. So welcome to the beginning of summer in Sydney. Beautiful day. So the Life Sherpa summer uniform has come out and we're ready to get started on talking about insurance. So in these sessions, it's largely about you. I'm going to do a little bit of an introduction to the topic. Then we're going to deal with some questions. So before we do get going, I just need to acknowledge the earliest recorded inhabitants of the land that today we call North Sydney, the Camaragal people. Anyway, with that said, let's crack on. So let me fire up the slides so you don't have to look at me anymore. So presumably everybody has done their homework and watched the video. So we're going to scream through this in the beginning and then we'll come back and deal with questions. It seems obvious when you deal with insurance. We all buy house insurance, we buy car insurance, we buy holiday insurance. It's all about paying some money to try and make a risk go away. Life insurance and products related to that are subtly different, and the subtle difference is important in terms of the ongoing. So generally when you've got normal house insurance, what's called general insurance, that's a product that's a claims made policy. So it deals with events that happen during the course of your insurance, so that if you get through the year and you haven't used your car insurance, you can very easily pop over to a competing provider if they give you a better price. Life insurance is a little different because most insurers, at least the quality product insurers, will go through a process of assessing your suitability for the pool. Obviously, you don't want all the sick people buying life insurance. What you want to do is make sure you get a reasonable representation of the population. And to do that, they're going to check your medical history in a process called underwriting. And that makes sure that the risk that the insurer is taking is covered by the premium and that they're getting a representative sample. This is all about spreading a risk so that everybody, in fact, pays the average cost of that event. And so you don't want to go through that process every year. So you've got to do something to make sure that it's still value and you don't end up paying a loyalty tax, but you don't want to incur the costs and the intrusion and the hassle of going through this process every year. So we obviously talk to the insurers every day of the week. We keep track of who's competitive. They all have their little sweet spots. So 30-something professionals will get a better deal at one insurer, especially if their book is a bit light in that area. Others specialize in older blue-collar workers. Some are better for smokers. Some are better for recreational drug users. And so the trick is to make sure that they're still competitive. And where we start to see an insurer moving out of their previous competitive position, that's when you start looking at moving. But they might be the cheapest this year, but not next year. But over time, it does balance out, and you just need to make sure you're in that sweet spot. So you might want to look at changing your policy. If you're doing it any more than every 5 years, you're doing something wrong. Where to change to your personal circumstance, which we'll come back later and talk about, there are definitely points. But this is not something that you look at your premium this year and go, oh, that's more expensive than last year, I'll go shop around. That's not how life insurance works. You need to be right on top of this market all day, every day. And you don't want to move for small amounts, especially if you've got an older policy. So if you've got a pre-2021 policy, you'd want to see a huge price discount to give up some of the benefits of those. But let's talk about that later, and let's crack on. As always, let's try and put this thing in the context of the Life Sherpa 9 Money Summits. So as you probably know, if you've been here before, we have 9 summits that you need to scale as you pass through life to get the most out of your money. We've got 3 foundation summits, which is spend less than you earn, build an emergency stash and pay off your debts. That's the foundation of any great plan. Then we got the protective steps, which are the things that help keep the rest of your financial life on track. Insurance, preparing for the unexpected, is step number 4. Superannuation, so get your super sorted and keep it going. Housekeeping is around wills, power of attorneys, guardianships, doing your tax returns, so getting all that stuff that gets in the way of life. And then finally, the 3 growth steps or growth summits, which are buy and pay off your home, invest your surplus, and enjoy your retirement. And tonight we're going to focus on summit number 4, insurance, preparing for the unexpected. Our financial freedom factor, which you're probably familiar with, is a tool that will allow you to assess your progress against each of the 9 money summits and where you should prioritize now and give you actionable next steps. So if you haven't done that, dive right in and get your personalized plan. So just to recap, for anybody who depends on their income to pay the bills or achieve their goals, and that second bit's important, you need a backup plan if you're unable to earn it. And insurance is the way you do that. So if you don't depend on your income for working to pay the bills or achieve your goals, you probably don't need income insurance. And if nobody else depends on your income to pay their bills or achieve their goals, then you might not need life insurance. And if that's you, then you can probably take an early mark and go buy yourself a beer. Well done. But for the rest of us, insurance is the plan you need for when the plan you have doesn't go according to plan. And there are lots of ways our plan can get derailed. But the way I like to look at this is when we think about the things that could go wrong that might set our plan off course, is you can look at the likelihood of an event happening. And some events are low probability, like being hit by an asteroid or being struck by lightning. And some are very high likelihood, like the odds of you breaking your iPhone, almost certain to happen at some point. And then we look at how impactful. So dropping your iPhone, a new screen for an iPhone is about $150 and not a big deal. A catastrophic event that stops you working for the rest of your life is hugely impactful. These are life-changing risks. And so we can divide those risks into 4 categories. We've got the low likelihood, low impact, and that's what your emergency stash is for. So they're for the things unlikely to happen this year, but you would be upset if they happened. And that's why we have an emergency stash. So that's the engine in your car fails, you need to buy a new one. Your parents in the UK get sick and you've got to fly over there. It doesn't happen every year, and so we need to plan for it. And because they're so highly likely to occur, insuring them is difficult and probably too expensive. So the cost of buying that insurance your telco will try and sell you for your new iPhone, generally not worth it. For the things that have got a very high likelihood of happening, so they happen most years, that is, you get sick and you've got to go to the doctor, but not enough that you're going to claim on your health insurance. You get a flat tire, you get locked out of your house, all of these things, fairly high risk, but still relatively low impact. And to fix these, we just build some fat into our budget. Some years we're going to use it, other years we're not. Moving across to the right, these are the stuff that have very high impacts, that it's a very unpleasant thing when it happens. And in those cases, almost regardless of the probability of them happening, that when they happen, they are so catastrophic that would be an unacceptable outcome. That's where insurance comes in. And insurance is really around spreading that risk across the population as a whole. So we know with great precision how many 30-year-olds are going to die this year. Nobody knows which 30-year-olds it's going to be. By spreading the risk of dying across a large pool of 30-year-olds, we can each take the average of those risks. And this is why the government makes us take out compulsory third-party insurance on our cars. So it's not about, if your car is worth $5,000 and you drive it into a brick wall, your $5,000 emergency stash will fix that for you. But it's pretty difficult to deal with the Bentley that you drive it into, or the McLaren, or the person that you injure on the pedestrian crossing. And that's why the government makes us take out insurance. And so when it comes to our lives or our income specifically, this is where that the loss of income for a week or two might be covered by your sick leave. Loss of income by a month or two might be covered by your emergency stash. But 3 months, 6 months, a year, 2 years, 10 years, forever, or till retirement, that's a impact that no amount of saving is going to solve. And the way to fix that problem is with the right insurance. And so the next step is, okay, now I've identified the risk I've got. And if you're 30 and earning $100,000 a year, you're probably going to earn $5 million between 30 and retirement. And 1 in 10 guys will die between 30 and retirement, 1 in 16 girls. So it's more common than you might think. So the next time you're out at a barbecue and there's you and 28 of your closest mates and you're all a similar sort of age, just look around you and go, who's not going to be here by retirement? It's more common than you think. So that's where insurance comes in. And there's a bunch of products that we use to bundle up to cover off this risk. There's not a lot of science in why these products developed the way they did. A lot of things in insurance are because that's how they did it in the 18th century coffee houses in London. It's just developed. Some of it's driven by regulation and some of it is driven by taxes. But for most people, the most important piece of cover for anyone who works for a living is income protection insurance. Sometimes this is called salary continuance insurance, which was probably a better description of what it does. And this is designed to replace your income, or at least up to 70% of your income, if you're unable to work due to accident or illness. And this is the common one. Most people will have a period in their working lives where illness stops them working. And for the most part, there will be a period that is longer than your sick leave, annual leave, and long service leave entitlement. And that's where this comes in. Now, it is limited to 70%. That's a legal limitation. So the question you said, what about the other 30%? Could I live on 70% of my income for the rest of my working life? The answer to that question is yes, and I'm comfortable with that, and I'm comfortable foregoing the goal achievements that other 30% is going to deliver me. Then we can probably stop there. You probably have now got most of the cover you need while you're still alive. So the next piece of cover we look at is TPD, or total and permanent disability. And that's where the illness or accidents that's stopping you working leads to a point where you're unlikely to ever work again. This is a lump sum rather than a monthly payment, that they give you a lump sum when this event happens. And so we usually work that out to fill the 30% that you can't get on your income protection. We look at the extra costs of living with a disability. And that's a bit of a judgment call, because there is a conceivable event where that could require 24-hour care 7 days a week for the rest of your life. Usually that's accompanied by an impaired life expectancy. And so we don't do that generally for 45 years. And it may also cause your partner to be unable to work full time, either because they've got to look after the kids or they've got to look after you. So we work out a lump sum that will, if invested over time, will fill in the 30% gap and pay for those extra costs. The other one that's useful while you're still alive is what's called trauma or critical illness cover. And that just pays out a lump sum when you get diagnosed with any of the list of events. And mostly they're cancer, heart attack, stroke, musculoskeletal problems. And this is a lump sum purely on the diagnosis. It doesn't have to result in you not working. Quite often it does, but it doesn't have to. And the benefit of this is that it obviously allows you to pay for medical treatment that's not covered by your health insurance or by Medicare, which sometimes can be very significant, particularly for cancers. It can provide breathing space for your partner to take some time off to look after you. And this is critical, particularly in the case of 40-something women who get a lot of stuff, cervical cancer, breast cancer, which may not stop you working for very long. And certainly today, in most cases, not going to kill you. But it can often take away the desire for work or create a need for moral and emotional support while you're going through treatment for that. And so critical illness can provide the breathing space for your partner to stop working. And then the final one, so those three deal with the risk while you're still alive. And then moving on to if someone else depends on your income, so you're married, you have kids, this is you, that's where life insurance comes in. So life insurance is probably the easiest one of these to understand, that if you die or get diagnosed with a terminal illness where you're going to die in the next 2 years, well, when you die, your family or your heirs, your beneficiary gets the lump sum. And if you're terminally ill, you get the money. And that obviously helps deal with the fact that your contribution to the household income and expenses will stop. It may require your partner to be able to work less because they've got to take up more of the home duties. And so we work out a lump sum that would solve that problem. So they're the four components. And so the core is income protection, then we build it up from there. Generally speaking, you would expect a comprehensive package to cost somewhere between 2 and 5% of your income. So if you're a 20-something professional, you are likely to be at or below that 2% number. If you're a 50-something smoking forklift driver, you're going to be at or above the 5%. But most people that we see come in a sort of 2 to 3% end of that. So one way of thinking about that is if you had a choice between two jobs, one that paid you $100,000 plus 12% super with 4 weeks sick leave, or one that paid you $100,000 plus 10% super with infinite sick leave, which would you choose? And probably just as importantly, what would your partner wish that you choose? So that's one way of thinking about it. And the reason I use the super bit is that most people will use their super to pay for their insurance. You may want to top it up, but that's a choice. But that's the most efficient way of buying it for most people. Not for everybody, but for most people. So that's the background to what we're talking about. And so with that, we can move on to the questions. And the first one that we got, and I touched on this earlier, is how often should I review my policies? And your renewal is a good trigger to think about this, but you certainly don't want to be changing your policies every year. So once you've been through underwriting, you've got your offer, you've accepted, your cover's now in place. Your contract with the insurance company will run for as long as you pay the premiums. But at the end of the first year, usually about 11 months in, they're going to send you a renewal notice. So your cover will go up by inflation, or at least they will offer you increased cover to take into account inflation. And usually the premium will go up because you're a little bit older. So insuring a 32-year-old is more expensive than insuring a 31-year-old. And so the premium will usually go up, A, because you're buying more cover, and B, because you're getting older. And then C, because insurance prices generally have changed. And that's a bit of a function of their claims history, the lapse rate, what the investment markets are doing, and how accurately they've estimated their loss rates. So at that point, you now get to choose, do I take this indexation? So if your income hasn't gone up, you might not need indexation. But for most people, their pay goes up and they need to increase their cover, since your cover is fundamentally driven by your pay. And then the premium will come out of your super fund or from your credit card, and life goes on. If you choose during the year to reduce or cancel your cover, you'll get a refund for the unused piece. Renewal is a good time to think about it, but it's not critical that you do it on that day. And you've usually got about a month's notice to look at that. But what you should be doing, and it's a good trigger to think about what's happened in my life that might change the level of cover that I need. If you've got a new job, change your occupation. So if you were a tradesperson, you moved up to being a foreperson or project manager, your risk category has now come down. So that might be a really good opportunity to get a lower premium because you're in a lower risk category. The converse doesn't work, that if you start off as an accountant and you become a carpenter mid-career, you still get to keep your accounting rating. So that's a bit of a one-way bet, that one. You might get married, you might get divorced, you might have an extra child, you might take out a bigger mortgage. All of these things are things that might trigger a need to review your cover. So there's a few triggers in the year. Obviously, renewal often makes it front of mind for most people. I like to do a lot of this sort of thinking on the day that the clocks change. So for those of you on the East Coast, at least New South Wales, Victoria, ACT, Tasmania, South Australia, clocks go forward in the spring. So we're about to do that next weekend, and they go back in autumn. So just as the fire department says that's the day you should change the battery in your smoke detector, it's a great day to sit and mull what's changed in your life over the past 6 months that might trigger a need to review both your insurance plan and potentially your other financial plans. It's a better day than your birthday because you're less likely to be doing something else. It's a better day than New Year's Day because you're likely to be doing something else, or Australia Day. The day the clocks turn back or forward is a great day to think about these. So that's often my day for contemplation of these things. You're also like to be a little bit out of sorts because you've had too little or too much sleep. And so it's a great time to think about it. But definitely you need to have this regular thought, what's changed in my life that might give rise to a change in my insurance requirements? And they're those sort of changes to your family structure, changes to your assets and liabilities, change the nature of your work or get a pay rise. Particularly important in your sort of 20s and 30s where your pay might be rising rapidly, less of a deal in your 40s and 50s when it's ticking up at inflation, which your indexation might cover off. It's a good time to think about it. If you're thinking about having a family, particularly if you're female, great time to do it before you get pregnant. That's the time to review a lot of these things. So they're that sort of the triggers. It's not like your car insurance where every year I get my renewal, I go and test it in the market. As it happens, for the last 15 years, Allianz's renewal has been competitive and I haven't moved. But every year I go through the charade of testing it out. That's not how life insurance works. You really only want to be moving when your insurer becomes non-competitive. So what we've seen this year is there's been a few acquisitions. So AIA took over a few other insurers and they've become relatively less competitive. So that might be a reason to revisit and go, that's a bit of an increase. The difference is big enough. I might be prepared to forego some of the benefits in my older policy, which I can't buy today, or the risk that I might get an exclusion or a loading on a new policy. So it's not as straightforward as getting like-for-like cover with one car insurer over another. And that's where a good advisor comes in. So we're in the market every day. So we see what's happening with these policies, and where we see an insurer getting uncompetitive, we'll reach out to our members in those insurers to consider changing it. May not be practical. If your health has deteriorated significantly, you want to hang on to the cover you've got. So the great thing about fully underwritten insurance is once you're in, they can't change the rules on you. And as long as you keep paying your premium, you get to keep your cover, regardless of how risky you become. And that's one of the big differences between standard insurance in your super fund or default cover with a fully underwritten retail cover, even if you pay for it from your super fund. Very important. So that's how often should I review my policies. So get your questions in while I'm dealing with these pre-ones. This is a fairly common question we get on a lot of these webinars, almost regardless of the subject is, what are the common mistakes that we see? We're doing this all day, every day. What are the common mistakes we see about insurance? The biggest one is I've got cover in my super fund. I don't need to look at this. That's partly because the government has mandated that all super funds offer a basic level of life and TPD cover to all of their members. In fact, it's a prerequisite for getting the My Super stamp of approval, which allows the fund to be a default fund for an employer. It's great for the 25% of the population who can't get direct personal cover because of their occupation, health, or recreational activities. So if you're a cell phone tower technician and you climb 50-meter towers, you're going to struggle to get cover. If you're a underground miner, you work offshore on the rigs, they're really tough occupations to cover. If you've had some very significant health issues, you may not be able to cover it. And so your super fund acts as an insurer of last resort, and that's really good. No taking away from that. Once you move up from that default cover, it can actually get quite expensive. If you look at it compared to buying widgets, you say, look, they're big buyers, they should be able to get a cheaper price. In practice, because they're more likely to have a poorer quality risk pool, they may actually be more expensive. And especially when you move up from the default level of cover. So Australian Super, for example, really cheap, basic level of cover, but that level of cover is next to useless for most people. So if you step up to a level of cover that does actually cover off the risk, that's not going to cut the mustard. So that's step number one. Step number two is the distinction between all those things I just spoke about. Once you're in the system, they can change the rules. That doesn't apply to group cover. So group cover or default cover in your super fund is a contract between the super fund and the insurance company. And that will change when the super fund goes out to tender. And of course, the super fund has an incentive to keep the price down, even at the expense of quality, because most consumers are incapable of assessing the quality of that cover. The quirks as to how you define TPD, that's the skill of being a good advisor, to be able to understand those. Some of them are quite legalese, and it's really tough. So most of the super funds, when they want to please the ratings agencies, they want low price default cover. So Australian Super, a few years ago when they changed insurer, they changed the definition of disabled very much for the worse. Now, I'm not picking on Australian Super specifically here. You know, when Rest moved their insurer either to or from AMP, I can't remember which way around it was, anyone who wasn't employed on the day suddenly lost the cover. So that level of change can happen. You may or may not get pre-existing conditions covered when they change insurer, and usually the level of cover is insufficient. So most people think, oh, I'm in a super fund, I've got cover. Usually it's inadequate and it's an inferior product and may be more expensive. So it's always worth reviewing. The other one I see is, I'm young, it won't happen to me. And the great other thing about this underwritten cover is that the younger you are, the cheaper it's going to be, and the less the risk that you've got a medical history that's going to stop you getting it. So getting in early is a big plus. There's a feature called guaranteed future insurability, which may allow you to increase that cover later on. Getting in early is really good. And the other one I see is, what about the NDIS? What about work cover? Isn't that going to solve this problem? And the answer is, the NDIS, despite the term National Disability Insurance Scheme, will not put a cent in anyone's pocket. It's designed to pay for services, not to put food on the table or keep a roof over your head. Hugely expensive, great benefit to many people, but it's not going to replace your income. Work cover obviously only covers events that happen at work. Generally, it's not going to cover a lot of things. It's designed to get you back at work and rehabilitate you. Similarly, car accidents, the TAC in Victoria in particular, isn't there to keep you going to retirement. And then the other interesting one is, we often see people with employer-paid cover, particularly salary continuance cover, which covers 2 years. That covers off the first 2 years. But what about the next 40-odd years? So it might be free or provided at a discount rate, but you might need to supplement the 2 years with another policy with a 2-year wait period. Or you might lose the policy when you leave. So some of those policies have the ability to replace it with a personal policy if you do it within a very tight window. Some of those windows have a requirement that you're employed at the time within that window. So if you leave to go travel over Europe, you may not be able to replace it. So they're probably the big mistakes that I see. This is the other one that we see a lot. So when we do insurance advice, we start with the calculation that we talked about earlier. So that will come up to a number. So here's the cover that makes all these risks go away. What if I can't fit that in my budget? What if I'm uncomfortable spending that amount of money? Where should I cut back? And mostly that's around cutting back the level of cover. So the one that's most important is income protection. If you're an employee and that's where your income comes from, you need income protection. And so the first thing you might look at is the waiting period. So you can generally choose 30, 60, or 90 days in the period between when the event stops you working and when you start getting paid out. That's designed because you usually have a few weeks of sick leave. You probably have an emergency stash. So the more comfortable the rest of your finances are, the longer the waiting period you can accept. 90 days is a bit of a sweet spot, accepting the first 3 months. That's like an excess on your car insurance. I'm going to accept the first 3 weeks myself, or 3 months myself. That will save you a lot of money. You might choose to reduce the level of coverage. You might say, I'm going to cover 65% of my income instead of 70% of my income, depending on how your finances work. The other lever you can pull is the benefit period and whether you have escalating cover. So the gold standard is that you have cover to age 65, because strangely, although most claims are settled within 2 years, so most people are back at work within 2 years, most money is paid out in the period after 2 years. So the real benefit comes in the longer term. So you usually buy 2 years, 5 years, or to age 65. The step up from 5 years to age 65 is not huge, but that is a way of saving some cover. The other place you can save a little bit of money is by choosing to turn off escalating claims. So generally, we would like to see that if you got cover 70% of your income, if you go and claim this year and you're still on claim in 5 years, you want that benefit to be increasing with inflation. Turning that inflation protection off will save you some money. But generally, when it comes to income protection, the two big levers that we suggest people play is the waiting period, with longer being better. 90 days, a bit of a sweet spot, but that relies on you having an emergency stash, and then potentially lowering the percentage of your income. But your income protection is the last place you should be looking to save money. That's the core. With the TPD, the big choice is, do I buy own occupation or any occupation? And so the distinction there is an own occupation policy will pay it if you're unable to do your current occupation, whereas an any occupation policy is cheaper, but will only pay it if you're unable to do any occupation that you're reasonably suited for by education, training, and experience. And for most white-collar workers, that's a fairly insignificant difference, that if you can't rock up at an office to be an accountant, you're unlikely to be able to rock up at an office and be a call center operator. Where it comes into play is you've got a train driver. That's a good example. A train driver who gets adult onset epilepsy ain't going to be able to drive a train. A pilot who gets diabetes ain't flying a plane for a while. Your train driver could work as a train guard at a significant reduction in pay. Your pilot may be able to do some flight planning or sim training type roles, but may not get paid the same amount of money. A surgeon who contracts Hep C is going to lose their surgical license, but could still do non-surgical work, but may not get paid the same. So they're the places where ONOC really matters. And it can be like a 50% increase. So it's a big deal sometimes, but that's a place to save some money. Life insurance is cheap, and so there's not a lot you can do there other than change the amount of it that you buy. Trauma critical illness is often the swing number in a lot of people's budgets. It's the expensive one in terms of dollars per dollar of cover. So if I were advising a couple, I'd say cut back the guy's cover, particularly if you've got a 40-something wife. Very keen to see women in particular have it. Guys tend to get stuff that kills them, heart, stroke, that sort of thing. And if you had to cut back, you might be better off cutting back a little bit off each policy. The one you really want to keep is the female one. So they're the big places to change cover. The other big one, of course, is to buy more of your super fund. Buying in your super fund does two things. One, it gives you a tax deduction for the premium, which you can only get for income protection. I'll come back to this in a moment when we deal with tax. But the other advantage of doing it in your super fund is that it's easier to pay it annually, whereas if you're paying it out of your pocket, many people feel more comfortable with a monthly payment that's easier to budget for. But you can save 10% or more by paying it annually compared to paying it monthly generally. That's not always the case with car insurance. So I pay my car insurance monthly. It's the same. It's a 12th of the annual premium. That's not how life insurance works. But definitely order of priority, IP, income protection, TPD, death, trauma. You're a two-income couple with no kids and the only joint thing you've got is a joint mortgage. You might be comfortable going, look, if I die, you can either take over the mortgage or sell it, and it's up to you. If you've got kids, that's a little harder to do. But that's the priority. But that's what a good advisor will help you work with. The inside or outside super. So I did touch on that in relation to being able to pay annually in advance. That's a plus. The other big advantage of paying it in your super fund is that it's immune to your daily spending. So as a family, you move from two incomes to one when you have a baby. You're confident that your cover is still paid for from your super without impacting your ability to eat while you're on one income. Your super fund will generally pay 85% of the cost to you personally outside super, setting aside income protection for a moment. But certainly life and TPD, you don't get a tax deduction personally, but your super fund does. And the benefit, looking at life cover, so a death benefit paid to a dependent is received tax-free. So you've got a tax deduction for your premiums, benefit received tax-free. Tick, all good. When the benefit is paid to a non-dependent child, that changes slightly. TPD is, again, you get a tax deduction. The benefit paid to you is taxable when you withdraw it from your super fund with a slight adjustment, but it can still work out better because you can leave the lump sum in your super fund. So that lump sum is going to pay 15% tax on its earnings until you get around to spending it. And you only pay tax on the income as you take it out. Whereas if you get a lump sum in your hands and you invest it, you're going to pay tax on that income, even though you're not going to spend it till next year or the year after. There's a bit more analysis to it than that, but the tax benefit's the other one. That's less of a concern for income protection because you are entitled to a tax deduction for income protection premiums that you pay yourself. So the economics are broadly the same. Obviously, having in your super means future you's paying it rather than today you. But let's assume that you're going to pay from your super and then top up your super. That's exactly the same thing as paying for it outside super, but it gives you the flexibility to change. And then the final one where it might not make sense is if you're earning $250,000 or more, where you're capped out on your super contributions because you can only put in $30,000 tax deductible each year, and 12% of $250,000 is $30,000. And you're also going to pay Division 293 tax, where your super fund pays an extra 15% tax on the contribution. So that might be a reason to buy it outside super. But for most people earning between 45 and 190, buying it in your super fund will generally make sense. Trauma, you don't get a choice. You have to buy it in your own name. So there's a fair bit of structuring thought to go on there, and that's part of what we will do when we do a piece of insurance advice. So this is getting to the, can I claim a tax deduction for it? So look at in your own name. The only one you can claim a tax deduction for is income protection. Your super fund, though, can get a tax deduction for life, TPD, and income protection. That's why we will almost always, there's no always, but almost always, in most circumstances, buying your TPD and life in your super fund is almost a no-brainer. It's not quite, but almost. Buying your trauma, it's not tax deductible either way, and you can't buy it in your super fund. Income protection, you can get a tax deduction, and your super fund can get a tax deduction. So now there's a choice. But if your super fund's paying for it, you don't get to claim the tax deduction. Your super fund does. So that's the big change. So for most middle income, so anyone between 45 and 190, would generally, for flexibility purposes, structure it in super to the greatest extent possible. And then to avoid the impact on your retirement, then make additional contributions by, say, salary sacrifice to pay for that premium. So economic, same place. You've been able to pay it upfront, get the lower price for annual premiums, have a bit of a breathing space if your income falls, and potentially tax benefits. So for all of those reasons, super makes sense. Where it becomes a little bit more delicate is if you're in that Division 293, so $250,000 of income, or you're otherwise seeking to max out your super contributions. So someone closer to retirement might be happier to get the money into super and pay the bill. You can usually move from one to the other. It's called a cancel and replace. It's a bit of paperwork, but generally doesn't require re-underwriting. So again, that's something you should be thinking about as you look at those life changes that might impact both the level of cover you need and where you should be paying it from. Again, think about those changes. So let's see in the chat if there's any questions. Oh, good question. The question there is, what happens to income protection when I go on maternity leave? Most policies use an averaging size, so they'll look at your income over the past 24 months and say, what's your best 12 months over that period? We'll generally see you through the first 6 months or a year. If it goes a bit longer, they will get to a point where the 70% is applied to a number that's ultimately zero. And so there comes a point where if you're off work for long enough, you can no longer get a claim. For many people, that's not a particular reason to cancel the policy if you think you are going to go back. There are quite a few pregnancy events that will lead to longer term health problems that may impact your ability to get the cover back. So for most people who are going to be off for 1 or 2 years at most, you're generally better hanging on to it. Some policies allow you to pause the premium while you are on leave. Not all, but some. And so be careful about that. Similarly, if you're going to take a year off and travel overseas, many policies will cover your income. So if you're going to work in London for a year, most policies will continue to cover that, but you do need to check individually. Yeah, so that's the maternity story. So lots of ground we covered tonight, lots of great questions. Thank you for that, everybody. We're just about up on time. Thank you so much for joining us for another Life After Hours, the place where we shine a light in the dark recesses of financial advice and financial planning. Until next time, bye for now.